Okay, welcome everyone. We'll start our third lesson. In this lesson, we'll cover our LO3. LO3 is our learning outcome 3. My name is Anjum Sata, and my email address anjum@ukversity.co.uk. Please, if you have any question, just drop me email if you're just listening this recording. And in today's lesson, we'll go through our LO3, be able to evaluate proposal of strategic decisions on the capital expenditures in an organization. So we'll go through capital expenditures. Do we know what is meant by capital expenditures first?
Expenditure of monies to procure plant equipment for project-related activities.
Excellent. Great. So that's capital. It's a long-term expenditure. Is a capital expenditure. So before starting our two-day lesson, we'll a bit recap, what we learned during our previous two lessons. Anything we remember what we learned?
We've looked at financial data, the different sources, creative accounting, how to make an assessment of various ratios, liquidity, profitability,
Well done.
cash position.
Yes, so we discuss gearing ratio, we discuss use of resources, 4 types of ratios we discuss. Very well mentioned management accounting, internal and external. Yes, financial accounting we discuss as well. We discuss 4 types of financial statement, income statement, balance sheet, cash flow, and statement of change in equity. And all this we learn in our lesson 1 and 2. Today we'll go through our lesson 3. We have 2 assessment criteria and then merit and distinctions for the criteria 2 as well, total 4, which we'll go through. Review methods for appraising strategic capital expenditure. So today we'll discuss about appraising methods. What are those and how we can appraise, if we are investing in any project, we need to look around that project is financially viable, why we are spending money, what will be the cost and benefit analysis we're supposed to do, what will be bring in the short term, medium term, and the long term benefit as a country, as a company, as a individual perspective as well. So evaluate the business proposal. We'll go through different proposal. We can pick any proposal and we can evaluate, like a lot of discussion about HS2, HS3. So different people evaluate is initially was 56, it was 56 billion or something million,
Something like that.
5 million. So it's a huge increase. So maybe our proposal, our appraising methods we use, we not look the properly inflation and various other factors. Why the cost is increased from 56 to 105. So we need to look around all others, not just so in any proposal we need to look around short term, long term, and medium term, all impacts, and economy and employment and various other things. So assess the importance of cash flow. Cash flow, of course, is very crucial any business. Lot of business nowadays not sustain, especially now due to the coronavirus. They have a stock, they have an asset, but they don't have a cash to carry on running and sustain in a business. So cash is a lifeblood for any business, so which we'll go through and we'll assess, impact of any proposal, what will be in the strategic direction of the company in the long run, in 5 years, as a mission as a company. So all this will be our focus in our discussion. Any question?
No.
Okay. So we'll start. Today we have key command word is evaluate, assess, and review. And of course, we can interpret some information as well within it. So that's, all our focus will be. And we have keywords, which we're supposed to be learn expenditure, different between capital and revenue. Do we know what is the difference between capital? We know the capital expenditures mean plant, machinery. What about the revenue expenditure then?
It's a revenue expenditure. That's outgoing spent to receive incomings.
Yes, normally we call day-to-day expense, like,
Yeah.
cleaning, maintenance,
Mhm.
wages. These are revenue expenses.
Mhm.
So, like, if you have a house, and if you just do the painting and coloring and change the carpet of the house, it is a revenue expenditure. But if you extend it,
Operating expenditure.
if you extend it, it's a capital expenditure, because the value of the asset will be increased.
Mhm.
So any expenditure which increase the value of the asset, that's the capital expenditure. Any
Mhm.
expense which we spend to maintain the asset in the same condition, that's a revenue expense, like
And
maintenance.
and that's different to operating expenditure.
Yes, we can say operating expenditure, running expenditure to maintain it, to run
Okay.
our operation effectively.
So revenue expenditure is the same as operating expenditure.
Yes.
Yeah. Okay.
So capital is long term,
Yeah.
revenue is a short term, which every year that goes in the profit and loss account. And capital expenditures goes in balance sheet. Those are our assets. Money spending our assets. Any question?
No.
Okay. Then we'll go through investment appraisal. Appraisal mean, of course, checking the performance. The money we'll invest now, what we'll get out of it. So time value of money. The pound we have today, the pound will get after 2 years, 3 years as a return. What will be real value of the money? All this will be focused in our discussion. Sources of finance, where we can raise the money internally, externally, and what effect will be on our organization, or the gearing ratio, which we discussed gearing ratio as well in previous lessons. Cash flow, yes, we'll look cash flows, cash inflows, cash outflows, receipts, and payments. Okay, so first thing we'll discuss 3.1 review method of appraising strategic capital expenditures project and strategic direction. So projects, what is meant by project? Any definition of project?
Something that has a defined start and end date.
Excellent, great. Yes, project can be a task, project can be any activity which is the start and end date. Yes, with the clear objective, what really we want to be achieved. So that's the project. Of course, project feasibility we need to be, and we need to do appraisal. Is it good? Because in this world especially, we can't say I have unlimited resources. We have limited resources, yes,
Mhm.
and we have unlimited wants. One of the great scholar, Neil Robin, in economics, he mentioned we have limited resources, unlimited wants. But how we can use these limited resources to fulfill our maximum wants, our desires? Yes, we need to find the various alternative, various options. So, and we have to pick the best option. So, Sam, in the business world, we have to pick the best options which we can maximize our return. So that's why we do appraisal. Appraisal is checking the performance. So we learn about performance when we'll check. Three things we need to be checked in performance: time. Time itself is a cost, yes.
Mhm.
Cost and quality. Any performance, anything we want to check, we'll always look in time, in cost, in quality. Maybe we'll just focus on the cost. We like numbers and we focus on the cost and the time, but we're not looking the quality. Yes, that
Mhm.
can strategically in the long run can be impact. Like we discuss about and we quoted example of Nokia. Yes,
Yeah.
so they reduce the cost, but they ultimately not performance in the long run. So we need to think about every decision have some advantages, some disadvantages. So our advantages should be more than disadvantages. Our benefit should be more than the cost. Okay, so investment, which we call capital expenditures, we'll go through today lesson, and it can be different appraising technique: return on capital employed, ROC, how much money we invest, how much return we'll get, payback period, the money we'll invest, how long will it take us, relevant, irrelevant cost, the the decision which I'm going to make, what effect will be on my cost? It will be any additional cost or not? All this we will go through in further few slides. Any question?
No.
Okay. Next now, investment appraisal is a business concept, of course, which we can expected future income derived from the investment. So that is appraisal. We looked in slide that will help other further to clearly understand the concept. So first, payback. One of the method appraisal is a payback. Always as a manager, we need to look around the payback. The money you invest, how long will it takes you to get the money back? Which is easy. If you invest £100 and if you get every year £50 back, it take you 2 years to cover your £100. Yes, which is easy. This is a payback method. Is very easy to calculate, easy to understand.
Would that consider any additional charges or costs such as maintenance of what you've invested into?
Yes, so we're looking the net cash, what you get, the investment, what you normally make. Always looking the net. So if you invest 100 and you get 50 net, yes, each year.
Yeah.
Back. So how long will it takes you to cover your 100? It takes me 2 years to cover my 100. Yes.
Yeah.
But this method is not looking beyond 100. If you're just getting 100 investment, but if you're getting 100 after 2 years, what will be the real value of that 100 after 2 years? So this method is not considering the time value of money. Because the 100 now is more worth it 100 you get after 2 years. So this method has the advantages. This method has some disadvantages, which we'll go through on the next slide. So if we look here, so we are going to invest. We've been given year not always current year. Year not mean the current year when we are going to invest something. So we are going to invest 3100 and cumulative column is my total column. So year one we are going to get back £1,000. So my outstanding amount still is 2100. Year two I'm getting again 900. Outstanding is at 1200. Year three I'll get £800 back and now outstanding is 400. So this project I can say by looking these figures now, this project will takes me 3 years and some months. I'm not sure how many months. So I have end of 3 years. I have outstanding amount. Outstanding amount divided by the following year inflow. 400 divided by 500 times by 12. How many months in a year? 12. So this project will take us 3 years and 10 months to cover what we invest. Even we don't need to calculate afterward, but we can calculate if we want to calculate.
To get the exact amount of months after the third year for the payback.
Yes, because otherwise we don't know. We can't say this will take 3 years because it will take 3 years and some months. 3 years and 10 months. No, this is, let's assume this is a project A.
Yeah.
And you have a project B as well. So we need to look around. If project B will give you 3 years payback period, so you go for 3 years, not 3 years and 10 months. Always shorter is a better. Like if you invest money in Apple, iPhone technology company, and you invest in BPP, which one you prefer to invest?
Apple.
Okay, because
we're about looking. I don't know.
Yes, you're right. Because Apple will give you the quick return. Yes,
but possibly.
Normally in technology company, if it's investment and the company's product will innovative, can get quickly return. But BP will takes you long because the oil and then sell and then of course you have to wait. If you can wait it, maybe you will get forever return. Carry on getting. And that's why the payback period is longer in the BP. So we suggest Apple is the best according to the payback period. So we can appraise it on both companies. Any question?
No.
Okay. Next we're looking discounted cash flow. Discounted cash flow mean like depreciation. The cash we'll get in future, it won't be the same value which we're getting today. So this is the business concept. Always we need to remember NPVs, and NPV stands for net present value. The money we will get after discounting, what will be the real value of the money based on our exemptions. Yes. So which we'll go through on next slide. Any question?
No.
Okay. So this is NPV takes into account the time value of money. So if I will say you lend money to someone and someone gives you back after 2 years, actually, as hospitality wise or morally as a human being is fine, no problem. But in the business world, if you get that money after 2 years, it's reduced its value. You want to get more than. So you have to, how much more than, yes?
Yeah.
So how we can decide? Do we know, of course we know the base rate. How much is the base rate now?
0.1, I believe.
0.1. If we'll go to the bank to borrow some money, how maybe we'll get around, in business world, around 3% interest rate, or maybe less even, huh? Depends.
What,
So,
for investing money or borrowing?
Borrowing money, yes.
Okay, yeah, maybe. Yep.
And then if we'll look the inflation, how much is the inflation?
Currently, I don't know, but it should be around 2%, but probably a lot less than that now.
Yes. So we'll say 2% for suppose, yes. And plus, what return really you want on your investment if you have money to deposit?
I'd like 10%.
You want 10%, yes?
Yeah, is that greedy?
No, that's fine. Fair enough. Okay. So if you add it all now, 3, 2, and 10, is cost of your capital is a 15%, yes?
Yeah.
So what you can do, you can use the discount factor. We call discount factor, yes?
Yeah.
So formula is, normally we've been given the discount factor table. We can find online always, in any project. But formula is 1 divided by 1 plus R. Okay, R represent discount factor. So if you do 1 divided by 1 itself, and what is meant by 15%? 0.15.
Yeah.
So if you divide 1 divided by 1.15, yes? So I'll do.
It's 0.869.
So 0.869. So 1.
Yeah, or 0.87. Round it up.
1 divided by 1.15. The reason I'm doing, I'll just, so which is 0.869, yes?
Yep.
Or we can round it up. But whatever the answer will come, if you carry on dividing 1.15, so year 2, 1 pound will be 75 approximately pence. Year 3, 1.15 will be, yes, 0.657.
Yep.
So it's carry on depreciating its value. So we need to make sure whatever the money will get, we'll go through next slide now, huh?
Yeah, so you're going to apply that factor to the income on the payback, and that will extend the payback period accordingly.
Yeah. So payback period is only look what you invest. In this one, we're looking the real value.
Yeah.
Based on. So that's we need to. Any question?
No. Carry on.
Okay. So next now, this NPV has advantage this method if you will use appraisal because it's considered a time value of money. But
Mhm.
sometimes this method is very difficult. I'm calculating the cost of capital based on various. I'm saying if you borrow money, I'm saying inflation maybe one person is saying 1%, other is saying 2%, yeah,
So there's a
and
lot of assumptions.
all these, so that's why it sometimes is a difficult, huh?
Mhm.
What is will be the real value. So in this case, next example, we are going to invest £20,000.
Mhm.
In £20,000, we are going to invest. How much we are going to invest? £20,000 we are going to invest, and
Mhm.
we are using the discount factor 10%. So 10% discount factor, which is PV. PV is the present value.
Mhm.
Okay, so 1 divided by 1.1. So year 0, which is £1 is a £1. After 1 year, it will be 0.909. In year 3, 0.826. Year 4, 0.751. So what we need to do, 20,000 times by 1, it will be 20,000. Then 5,000 times by 0. If you are getting in a year 1 5,000,
Yep.
actually the value of 5,000 will be £4,545.
At the end of the first year, the income of
End of the first.
5,000 will be worth that. Yeah.
So that will be real worth. If you get 7,000 at the end of 2 years, that 7,000 value will be £5,782.
Mhm.
And year 3, if you invest 8,000, if you get 8,000, 8,000 value will be £6,008. So what we need to do now, we need to add the positive values. Yes.
Yep.
Okay, let's will do now. So calculate all the positive values. 4545 plus 5782, 5782 plus 6008. So my positive figures total is 16,335. Yes.
Mhm.
Minus 20,000, which is my outflow. So my still is 3,665 pound negative. Yes.
Yep.
So when NPV will come negative figures, we reject the project. We're not going to accept it. We're not going to invest in this project. If NPV is a positive, we accept the project. If NPV come negative, we reject it. We can argue why maybe social benefit more, or here we purely looking in the financial terms.
When you're saying it's negative, but that's only looking at 3 years cash flows. If you were to look at a fourth year's cash flows, surely that
Yes,
would return
you're
your initial
absolutely
investment.
right. But maybe some project won't give me if I have a machine. After 3 years, the machines totally will be scrapped. Yeah,
Mhm.
and even there won't be any scrap value. Can be outdated. Yes.
Okay, I understand it.
So yes, you're absolutely right. Some project can be forever benefit, like investing money in education.
Yeah.
Yes, maybe you get the job, really good job, and will carry on because the knowledge is on investment, on research and development, never stop.
Mhm.
Maybe we can develop one product and we'll develop second project based on that knowledge. So that's we can appraise. Any question there?
No.
So that was NPV. So NPV positive, accepted. Payback period less is a better. And next we looking ARR. ARR is called average rate of return. What is my average rate of return of any project, whatever we invest? So which will go through. Any question here? Okay. So we need to remember the formula. Average profit divided by initial investment time by 100. Any question?
No.
Okay, let's now. So we'll look example. We have 3 projects: Handover, Bristol, and Carlisle. So we've been given the years. We've been given how much is required investment. So A required 4 million, B required 4 million, and C required 5 million investment. If I'll go for A, it give me 1 million every year profit up to 5 years. In 5 years, 5 million minus 4 million, so my profit is 1 million divided by 5, so my average profit is 0.2 million. 0.2 divided by 4 times by 100, so I'm getting average 5% profit every year. Any question?
Say that again. So you've got 1 million profit each year over 5 years.
No, we are getting 5 million profit in 5 years.
Oh, sorry. I said
4 million.
Yeah, I've got you. Yeah. Sorry, I looked at total profit.
1 million. We divided by 5. Average is 0. Yes, 2.
Yeah.
We do divided by 4 and times by 100.
Yeah. Sorry, I didn't take off the initial investment. Yeah.
Then we'll go for the second one is a 5%, and if we'll go the third one, Carlisle one, we'll get 8%. So which one you want to go?
Carlisle.
Okay. What is the problem in Carlisle? No doubt is more return there, 8%.
There's no return in the first year and a very small return in the second year.
So first year you're not getting anything. So here we can consider if you reinvest in 1.5 million, will you get year 1 back? So maybe you can multiply, which we not consider it. Compounding interest, yes?
Yep.
And in Carlisle, we required 5 million investment. Maybe we don't have a 5 million. So all these factors we need to keep in mind, and then we can decide which one will go ahead.
Yeah.
So according to this, yes, our ARR, we can go for Carlisle. So in same way, we can look around different project you can compare 2 projects, project A and B, and you can calculate the payback period, you can calculate NPV, you can calculate ARR, and you can argue you will go for A, you will go for B, huh? Any question?
No.
Okay, that's all about investment appraisal. Okay, so I added some examples which we can look around. Okay, next now we looking, of course, when we looking next is our budget. So second, we looking the cash budget, 3.2. A plan expressed in money, it is expressed prior to the budget period and show the income and expenditures. So we look the budget. What is meant by budget? Budget is a financial control, yes? If you budget is a financial plan, where we are, where we want to go. If we don't have a budget always we learned about responsibility accounting, or maybe you heard about?
Sorry, I didn't hear that. Say that again, sorry, Andrew.
Responsibility accounting.
Have I heard of it? Yeah, I have, but if you could explain exactly what it means.
Yes. So first, suppose if your role, let's say your role is a manager, you have to manage. You always given the budget, yes? You've been given the task, and you will be responsible against this budget, yes? So that's called responsibility accounting. So your performance related pays and all other things will be calculated based on this. Okay, that's a responsibility accounting. You've been given budget, you've been given responsibility, and you will be accountable against it. And if you have, we gave you budget for suppose 56 million to complete HS2, yes? And actually we spending now 105, yes? Something. And there is a difference, variance, yes?
Yeah.
and that variance is, we can take the difference, yes, which is
49.
sorry,
Is it 49?
49. Okay, so 49 million is the difference, yes.
Yeah.
So we can argue now why this is a response, because you've been given 56 million, you spend it 105. 49 million is a variance which is adverse, yes.
I think they wish it was million, not billion.
Oh yes, it's yes, you're right. Yes, it's a billion. It's a billion, yes. So we
It's billion, yeah.
why 49 billion more, yes. Is it due to the poor? Yes. So your responsibility accounting, maybe we can say, hang on a minute, and you still demanding as a performance related pay. So which is no point, yes. So we need to look around the budgetary control to stay within the budget.
Yeah.
Okay. Next, now within that 3.2, we also need to be look around sources of finance, where the money will come from. So there are different sources of finance we can raise the money. So it can be short term, long term, and medium term. Lease. Do we know the lease?
Yeah.
So lease can be two types: operating lease and finance lease. Operating lease is mean asset you're just using as a rent. Finance lease is mean the cars will be yours from the day first. So all the risk and reward you will bear it. You just carry on paying the payments. And then we have different equity and debt financing. Equity means share. Debt mean you borrow money from the bank. Normally, debt financing is cheaper than equity financing. And other different sources of finance as well. So we can look around each advantages and disadvantages of sources. So when you consider anyone, always look, when you're preparing budget, you should always start considering what your strategy, what your objective. Considering strategy and objective affect the way we allocate the cost resources within the organization. It gives us framework for preparing the budget. Any question?
No.
Okay, next we're looking the budgetary control. If you don't have a control is known as a corrective action. So in our organization, we need to be system in place, reporting system, control system. So we have a control in place. So budgetary control, variance is a budgetary control, yes. We look budget, we look actual, why we spending, huh? We look this year, last year performance. We compare this project with other projects. That also help us. So classification of budget, any budget you want to prepare, doesn't matter whatever budget. Always first thing we need to consider is a sale forecast. Every budget is based on the sale forecast. If the sale forecast is dropped, why you allocate more? Why you need more personnel? No point. Why you buy more stock? Yes. Why you need more capacity? So first thing is a sale forecast. If your sale forecast is wrong, all your other budget will be wrong. Yes, that's why economic situation to monitor is very, very important. So long-term budget, short-term budget, yearly, current budget, and rolling budget. Rolling budget, the budget will carry on change. Some budget can be zero-based budget. Every time we start with the zero, we're not looking previous years. Some budget can be capital budget, research and master budget. We all know master budget. What is meant by master budget?
A budget that reflects all of the other budgets within an organisation.
Excellent, great. So master mean overall budget, huh? Whole country budget is a master budget. Then council and local budget can be fixed budget. The budget stay the same, doesn't matter. The user will increase or decrease. Then of course we have a issue waiting time in NHS. So we need to be, it's not being increased as the user increase accordingly. So flexible budget, the budget change according to the activities. If activities increase, budget will increase. Any question?
No.
Okay, then capital expenditures we already discussed is investing money on non-current asset. Cash budget mean investing money and managing cash in and out. So now we looking example. Can we a bit read? We've been given slightly old example, but we can use it. We can change the year. So we can say we've been given the sales, yes? We've been given the purchase, wages, salaries, and sundry expenditures. The cash at the 1st October was 15,000 our balance. We have a policy 50% of debtors. Debtors, do we know what is meant by debtors?
Somebody who owes you money.
Debtors mean the credit customer. You sold the things on credit, yes?
Yeah.
And they will pay us 50% our debtors. Customer, they pay in the first month. 50% they pay in the month after the month, yes? End of 2 months. So 50% of 52,000, 50%. What will be 50%? 26,000. We'll get the money in the month when we'll sell it.
Yeah.
So July 52, 26 will get in July. 26 will get money in August, yes? Then August 1, 50% will get in August, 50% will get in September. So September 1, 50% will get in September 50%. So we need to manage the cash, yes, based on this.
Yeah.
Then purchases. 50% goods we are purchasing from one supplier, and that supplier give us 10% discount. So what is the 25,000 50%? 12.5. And we're not paying 12.5 because they are giving us 10% discount. So 90% of 12.5 will pay.
Yeah.
So that will be our outflow cash, yes? And then we'll carry on remaining 50%, which will be 12.5 will get in the following month. Then
you'll pay in the following month, yeah?
Yeah. So wages we've been given, and we've been given the criteria of the wages. It's the last one. So wages will be 1 week arrears, yes? So if we have a 4 week in July, so divided by 4 times by 3. 3 weeks will pay in August, in July, and 1 week will goes in August. And some months we have a 5 weeks, so we'll divide it by 5 times by 4. So 1 week salary will go in the following month because we're keeping it, yes? Arrears. And then we have a new equipment which we are thinking to buy in the month of November. So we'll see which month we have a negative cash flow and we need to arrange the sources of finance for it. Yes, if we don't have a money, because otherwise we'll be out of the cash.
Yeah.
Now what we did now, first, this is the template which I'll send you. We enter all the sales figure there, yes?
I think it's on Moodle.
Yes, it should be on Moodle. Further, I'll upload as well. So can we look here? We've been given amounts, yes?
Yep.
And then we have a July, yes, which I said 50% in July. So we'll do each column total, yes? That's my cash total, my receipt through sales, yes?
Yeah.
And we've been asked only prepare the budget for 3 months, October, November, and December. And purchases 50%, and we'll pay 90% of this, yes?
Yeah.
Because we are buying one supplier, they're giving us 10% discount. Any question?
No.
Okay. Then we'll do opening balance. We'll start with this. And then the receipt in October total through our sales. That's my total inflow, the cash coming in. That's my total outflow, the cash going out.
Yeah.
The difference is my balance. So in October, I have a positive balance. In November, I have a negative balance. This month closing, next month opening, yes?
Yep.
The link with. So this month, why my balances went negative? Because 35,000 I have used toward, or I will use towards the equipment.
Yep.
So I have to make a decision now, the equipment, maybe I'll go for lease, yeah? not instead of buying. If I need to buy it myself, my cash balance will be negative, where I will range 11,655. So otherwise, I'm not going to meet my expenditure. Then we look December as well, yes. And in December we have still negative, yes, but it's reducing negative now. So this way we need to manage our cash. Huh? This is called cash forecast and cash budget. Huh? Okay, so that's all. And sources of finance, when we raise money, four things really we need to look around: the cost, duration, term, gearing ratio. We already learned if you have a high gearing, lot of money you borrow it, you have a lot of liability, you will default. So always we need to be managed. Accessibility, yes. So all these, when we decide which source of finance will go, we need to look around how long this money required, how much cost me, what interest rate I'm paying, what effect will be my ratios, yes. Do we have accessibilities? Yes. All this we need to look around. Then the sources of finance can be internal. You can raise money internally. You have a retained profit, previous year profit, that money you can use it. You can sell spare asset. You can have to receive money from customer, and that money maybe you can offer them some discount and you can receive early, or you can sell invoices and you can raise money. Any question?
No.
Okay. External sources of finance can be bank loan, overdraft, share issue, leasing, hire purchase, mortgage, trade, government grant. So loan, capital, bank loan, we can look around the long term. In the loan, then we can look around how long we require, 5 years, 3 years, will use the bank overdraft or will go through the bank loan, short term, and which loan will go through. Share, we'll issue more shares. Do we know how many types of shares?
I know there's preferential shares. I don't know how many there are, how many different types there are.
Yes, so different types of shares. So preference is mean you give the preference, yes. You pay the fixed return on the investment. But preference shareholder don't have a voting right. Ordinary mean or normal investors, they have a right to vote. So if you issue more ordinary shares, so you have a less control as a director or the CEO. So you need to think about if you issue too many ordinary or too many preference, yes. You need to make sure it's a good balance. Do we know the business angels?
No, not heard that before.
It's mean rich people, yes. They can invest, in the companies. Huh? They are happy to buy the companies loss making. Are they happy to inject money in those? Huh?
Yeah.
So then next we're looking 3.1, 3M1, which is assess the importance of the cash flow management. We know the cash flow management is very important. If there is no cash, like we've seen in the previous example, the nature and the purpose of financial management is all about efficient acquisition, deployment, both short-term and long-term financial resources. And you get quickly, like we learn about payback period, NPVs, ARR, yes? All about to be manage the cash. Decision must be taken in 3 areas. Investment. So in which asset you invest, how long, and your working capital. Do we know working capital?
Is that like cash available?
Yes, you're right. The cash available or any asset which can convert quickly into cash.
Yeah, liquidity.
Liquidity ratios. Well done. Current asset minus current liability. Yes. So we can say trade receivable days plus inventory turnover days minus trade payable days. That's called working capital cycle. Okay, finance, of course, we need to look around the sources. Dividend. We all know dividend, yes?
Yeah.
Dividend is return on investment if we have on shares. Okay, investment decision we can make on the basis of the investment appraisal. and we can decide, which one. We look the project A, project B in the previous example, and we can look any company of our choice, yes, and we can we can argue on those, investment decision. Financial consideration, is it always we need to look around just, return, or anything else we need to look around? What else? I mean, in the financially, is project is viable, that's fine. What else we need to look around?
Political, environmental factors.
Yes, so we need to look around the micro environment, yes, political, economic, social, and technological environment. And we need to look around always social accounting, which is, have we ever heard about social accounting?
Is this more to do with the consumer or the customer? And
I mean, in a money wise, maybe we can invest in China, or we buy the thing from China. It's a cheaper. But if everything we buy from there, what will be happen in terms of the job market? Yes.
Yeah.
In every call center, we move outside the world. Yes.
Okay, I understand. Yeah.
So that's, will be social impact. So social accounting, we will be accountable for it. So that's all we need to when we'll go for recommendation. Yes, we can draw the recommendation like I quoted CareTech PLC, understand the financial system. Yes. If we not, we need to look around equity and the debt management. We need a good system in place. We manage the value of money and satisfaction with the service if we are a healthcare organization. Any question?
No.
Okay. Next we have a 3D one. Assess the impact of the business proposal, strategic direction. Like here example, a company is a smart objective they have. Company is a debt might have the following objective. Yes. So we want smart objective. So we want improve performance. Yes, that's why we have a debt. Improved profit before tax. We want measure able is the improved profit before tax. We can measure improve profit before tax by 20%. Then achievable improve profit before tax by 20%. Improve profit before tax by 5%. Is it achievable? Yes, we need poor objective. Yes, and we need to improve objective. Yes. Relevant, improve profit before tax by 5%, reduce debt by 15%. Yes, we need to look around. Is it relevant? Yes. Objective? Yes, can be. We can reduce debt. If we are reducing debt, ultimately we are improving as well. Yes. Time bound? Yes, reduce debt by 15%. But reduce debt by 15% within how many months? Within 18 months from. So we can include the dates as well. Time bound, yes? So each proposal we can look around what impact will be on. Then when we do the strategic analysis, the approach break down the process of strategic planning in through 3 different areas. Always we need to look around what is set missions, establish objective, and review your control always. Yes. Internal appraisal, external appraisal. Stakeholder appraisal, stakeholders, yes. Internal, external, both. Generate strategic options. Look around, choose the choices and plan and implement the strategies. That will help to be achieved. Any proposal we do, we need to look around all this, yes. Maybe we're looking money side, but we're not looking other impact. So this is one of, the example, NHS, England budget. So if a NHS trust, want to be planned, so they have to look around, now the government 3.4% growth in the real term, NHS, England budget over the next 5 years. So what we need to do, we need to look around what is the inflation mean, cash term, yes, 3.6% next year. We need to look around, is it the money we are getting, is it more or less? In real term, we are getting less every year. Yes, so we need to be maybe doctor salaries and national minimum wage is increasing every year.
Yeah.
So we need to look around. Is it matching? What will be happen all these? So if we look, the cash, yes, real and real change, in the pension adjustments as well each year. So if not, so where the money we need to be arrange it, yes. Some proposal we need to. Maybe we can think about private patient, or we can promote NHS, abroad, and we can provide the treatment international patient, and maybe we can generate some money is NHS is doing as well. So maybe we need more marketing side here. Any question?
No.
Okay, I copied one of article. Is quite good where are the various proposals as well. Yes, we can argue on the investment, and I copied few case studies. Yes, one of the council BG Group is a British gas. Yes, so how they in the new project, and one of the case studies managing store relocation project, which is Marks and Spencer when they move to Kendall, and how, why, and what sort of the thing they kept in mind, how they conducted investment appraisal for this store. So this is all, and then we have a bit quiz as well, yes, which we can play. It's all about an investment appraisal.
Okay.
Any question?
No, thank you.
So some reference there. If you want to extra, you can use some links there. Those are given within slide. Okay, so all today lesson we learn about investment appraisal, we learn about sources of finance, we learn about how we can appraise the different proposal and strategic, and we discuss about capital expenditure, what is meant by. If you have any question, please drop me email on my email address anjum@ukversity.co.uk. And thanks for attending. In the next lesson we'll go through. We almost finish and then we'll go through our assignment brief.
Yep.
Thanks for attending.
Thank you. See you tomorrow. I'll speak to you tomorrow.
So, yes, speak to you tomorrow. Thank you.
Thank you.